Welcome everybody to the first quarter 2026 commercial real estate capital markets update. This is going to be a recap of our Fear and Greed survey results. Fear and Greed survey is a survey that we do every quarter in partnership with CRE Daily. My name is Alex Thomas. I'm a research manager at John Burns Research and Consulting. I'm also joined today by my colleague Chris Nebenzahl, who leads a lot of the rental research we do at John Burns. I'm excited to get into it. I'm going to do a recap of our most recent survey results, and then Chris is going to do a deep dive into the multifamily space. So we'll go ahead and get into it. Real quick, a little bit about who we are. So we're John Burns Research and Consulting. Really, our bread and butter is the housing market, but we have clients all across the real estate space. We have clients who are land developers, private equity, rental, home builders, single family rental, professional services, bank lenders, everybody across the spectrum in terms of anybody who's interested in investing or building residential real or any kinds of real estate. That's really who our focus is. So we look at the industry from every angle. We have a really diverse client base. We learn a lot from our clients. We also, when we're thinking about the market, we use a top-down approach. So we have an in-house demographics team. We spend a lot of times looking at economics, policy, all the big forces that shape real estate markets across the country. In addition to that top-down approach, we've also got a really great bottoms-up network that we use. So we're John Burns Research and Consulting. Chris and I are on the research side. We've also got a huge network of consultants all across the country who have really deep local market expertise. And so we rely on them a lot when we're building our thesis, our forecast for the next several years. We rely on the local market intelligence that we get from our consulting team as well to build out our thesis. In addition to our on-the-ground insights and our top-down approach, we've also got just a wealth of data at our fingertips in terms of our proprietary database. We've also got a number of monthly surveys that we do as well. I think we're up to 16, 17 surveys, something like that at this point. We put a lot of emphasis on surveys, especially on sentiment across the industry. We tend to find that sentiment leads some of the more traditional indicators. So we spend a lot of time looking at sentiment, including in our Fear and Greed survey here. And then, of course, we also have some other things that you get as part of being in the John Burns extended universe. We do special conferences for all of our clients, reports and white papers as well that are topical. I won't go through all of this, but just a host of things that we do on a monthly or quarterly cadence here. We, of course, focus on B2B insights, but we also have some B2C insights as well. We do regular surveys of things like BTR tenants. We do surveys of U.S. homeowners and renters, architects, master plan developers, a lot of different places that we cover across the housing and the real estate market in general. So getting into the survey here. So, of course, this was our first quarter of 2026 survey. We run this survey every quarter here. This is, again, a partnership that we do with CRE Daily. Survey is sponsored by InvestNext as well. A little bit about the survey. So the goal when we were putting this together was really to build a survey that was a timely indicator of commercial real estate investor sentiment and expectations. We focus on, all right, what are you feeling right now and how are you feeling about the near future? Especially important at a time like now where there's not a lot of transaction activity going on. We would lean heavily on some of the sentiment to get an indicator of what's going on in the market, which I think we'll talk about in a little bit here. We have a pretty diverse base that we survey. We have a lot of owners, operators, GPs, LPs, brokers all across the industry. Every quarter, we tend to get somewhere between 400 and 1,000 market rankings, and that's from investors all across the country. This most recent survey period ran from early February to mid-February, so that's an important timing note because it was before some of the recent conflict here with some tensions geopolitically here. So just keep that in mind as we're going through some of the survey results here. But I think still really worth looking at. And then we focus very much on 4 commercial real estate sectors primarily: multifamily, industrial, retail, and office. The colors are going to remain consistent throughout this presentation. So purple is going to be multifamily, blue will be industrial, etc. here when you're looking at some of the charts. Our sample, we also make sure that it's geographically diverse. So we make sure that we capture investors from all across the country. And we focus primarily, our sample focuses a little bit more on the larger investor side of things, which is great because larger investors tend to be a leading indicator of the broader market as well. So our overall Fear and Greed index is now at 57. What does 57 mean? So our index is on a scale of 0 to 100. 0 is there's more fear in the market. 100 is there's more greed in the market. And our index 50 is a stagnant market. So we're tracking investment activity, we're tracking expectations. Anything above 50 is going to be expansion. Anything below 50 is going to be contraction. And 50 is going to be a stagnant market. A healthy market on this kind of index is probably somewhere between 70 to 90. So we're in expansion territory, a little bit closer to stagnant though, and well below that healthy market indicator. The way we build our index is a composite index, so we ask several different sentiment questions to build this. We ask about investors' current investment strategy. In the last quarter, did you increase, decrease, or hold your investments consistent relative to the prior quarter? We also ask about expected investment strategy. What do you think you're going to do over the next 6 months? Even if that changes, what do you, in your near-term outlook, what are you thinking about doing? Forward-looking indicator. Then, of course, a really important velocity component as well is what is access to capital, or how is access to capital changing? Is it getting easier? Is it similar? Is it harder to access capital this quarter versus the prior quarter? So again, we saw the index is at 57. That's a slight tick down from the last quarter, but really been pretty consistent over the last, call it 4 or 5 quarters here, even longer, in terms of commercial real estate investor sentiment broadly. And that's, again, across all 4 sectors here. And again, healthy market, probably in that 70 to 90 category. When you look into some of the specific index values here, why is it so consistent? Well, probably the biggest reason here is that current component. We ask investors, are you on pause? Are you decreasing or increasing your investments in commercial real estate? 72% of the investors in our survey said that they're holding steady. A lot of investors, we also have a comment box at the end of our surveys where investors can write in. We have a lot of investors citing general market uncertainty this quarter. That's been a trend for the last several quarters, but especially this quarter, we saw a decent pickup in that as well. Good news is we're not seeing a lot of decrease on there, not seeing a lot of red. But 72% holding steady, still the highest in our survey history here. Now, one thing that had been driving the overall index up over the last several quarters has been this question that we ask around access to capital. We did see investors saying that capital is getting easier to access over time. We'd seen steady improvement quarter to quarter, essentially since we started doing this survey back early in 2024. This is the first quarter where we've seen this kind of plateaued, and I think this ties into, we just got a Fed meeting, they didn't change rates. I think that ties in here. So we're not seeing the same kind of lift in the overall index from this particular component that maybe we had been seeing before. When you look at the sector level, though, we've seen some divergence. So not a lot of movement at the top line, but when you dig into the actual sectors, you did see this tick down for multifamily and office sentiment regarding access to capital, but you did see a little bit of a pickup in terms of retail and industrial. And I think that's going to come through as we look through some of the details around some of the sector specific headwinds as well. The good news across all of this is that expectations are still positive across the board. So across every sector, we do see more investors saying that they're planning to increase their investments versus decrease over the next 6 months, and so that's a positive. Generally, expectations are in a good place. When you look at this across, when you look at the actual index that builds this, or the question that builds this, we see about 38% saying that they're planning to increase commercial real estate exposure over the next 6 months. That's compared to just 10% who expect to stay consistent. So some optimism among investors here. Now, every quarter we can ask a certain number of, we call them questions of the quarter. We tuck in unique and timely questions into every survey. So we have the standard index questions. Then we ask some unique and timely questions as well. One that we asked this quarter is, how do you expect your cost of capital to change over the next 6 months? And again, see that asterisk over to the side. This was fielded prior to any international conflict here or any issues with oil and gas prices and that. But when we fielded the survey, at least, investors did say that 36% of them expected their cost of capital to decrease over the next 6 months. And so I think that fueled some of the optimism that we saw across the rest of the survey here. That's compared to just 12% who expect their cost of capital to increase. We also asked about, all right, how do you see the direction of the 10-year Treasury going? What we found was 48% of investors, that's the 10% plus 38% over on the left-hand side, expected a decline of at least 25 basis points in the 10-year Treasury by December of 2026. So did expect some easing credit conditions there. And again, fielded prior to some of the volatility that we've seen macro level over the last several weeks. I call that out because I think right now one of the challenges, and we're not the first to point this out, but as we see higher oil prices, I think if you're the Fed right now, you're looking at that as a potential inflationary pressure. I think in our view, the high level, we weren't expecting a ton of rate relief this year, but I think this compounds that a little bit, probably making rate relief a bit less likely this year if this drags out. Another question that we asked in our survey was on alternative investments. And so we wanted to tuck in something on data centers specifically. So we asked, all right, which of the following sectors do you believe will have the best risk-adjusted return over the next 10 years? And the majority of investors in our survey said that the largest share said that data centers were the best risk-adjusted return. I want to spend a little bit of time talking about data centers because we've done some other work on this in the past as well. This kind of blew my mind as I was pulling this chart together. If you look at the census pulls together data on spending across the country, you can see that this is on new construction spending specifically. The blue line there is data center construction spending, and then the green line there is non-data center office. And so we've seen a pullback in office construction. We've seen this rocket ship up in data center spending. And these two lines are about to cross. So we're probably in the next month or two going to see data center construction spending outpacing office construction spending, which I think is a pretty big regime shift across the economy here. One thing that we're also noticing, and again, our bread and butter is really on the residential side, but I think this applies to a lot of to real estate in general right now when you look at the data center component of the market right now. We have a survey that we do, this is separate from our Fear and Greed survey here. We do a survey every quarter of residential land brokers. And so we asked a question this last quarter. We said, in the past 12 months, have you seen any residential lots or land sold for data center construction in your market? You know, it's not consistent across the country, but definitely in places like the Midwest, the Northeast. You've seen land brokers are telling us that they're seeing residential lots and land sold for data center construction in their market. And so we're starting to see this kind of element of data centers competing with other types of construction for land, for labor, materials, other resources, right? We fielded this right before a really great Wall Street Journal article came out that talked about the same thing, at least from the perspective of some of the builders right now, talking about data center construction specifically. In addition to the land side of things, we're also seeing some competition on the labor side of things as well. Data centers often pay more, data center construction jobs often pay more than other types of both residential and non-residential construction here. There's a great Wall Street Journal article about that a couple of weeks ago. And then this is a quote from the Federal Reserve does this great thing called the Beige Book. It's a qualitative survey of contacts all across the country. And this is a quote that's stuck out with me since last October is when I first read this. There's a quote from one of the contacts of the Fed saying that they were seeing in their market skilled workers being hired away from residential and over to data center construction. I would guess that this applies as well to other aspects of real estate construction as well. One thing that we're seeing in addition to the labor side is also on the materials side. We've seen some cost relief for builders. Right now, construction is slowing, even though we're seeing a contraction in residential contractors. We're also seeing construction slow. And so we've actually seen some cost relief for builders right now on material costs. But some of the places where you're not seeing as much relief, or you're still seeing price increases, are some of these categories where perhaps the builders and other groups are competing with data center construction, things like plumbing and HVAC, things like steel and aluminum, although that's probably partly a tariff story. Things like foundations and concrete, insulation as well. So some early anecdotal evidence that we're seeing some of this competition being a factor. One final thing I wanted to touch on here is we also asked investors, we did this last year as well, we asked, all right, what do you think is going to be the biggest obstacle to your sector in 2026? We got some really interesting changes both between sectors as well as year over year here. So I'm going to walk through a couple charts really quick. So the gray line on these charts is going to be last year, and then the colorful lines are going to be this year. So starting with multifamily, and I'll let Chris touch on this a little bit here in a moment, but we saw last year that big gray bar under interest rates and cost of capital. Interest rates were the #1 concern for multifamily last year, but that's changed this year. This year, you've seen that really replaced by concerns over oversupply. We've seen some rate relief come down, but we've still got a lot of supply moving through the market. I think that the challenges with oversupply are maybe compounded by another element here that I know Chris is going to touch on as well, which is this weak tenant demand piece. I wanted to call that out because we saw a big jump in the share of investors on the multifamily side who are citing weak tenant demand as an obstacle. And that's not something that we've seen really up until I think this year, where we started to see some weakness with the labor market. Up until now, absorption's been pretty strong on the multifamily side, but I think we're starting to see some signs that maybe there's some weakness coming there on the multifamily side. Moving over to industrial, again, interest rates were the number one concern for the industrial space last year. It's changed to oversupply now, so some pretty big shifts on a year-over-year basis here. On retail, interest rates and cost of capital were number one last year as well. Now you're actually seeing weak tenant demand picking up here. So I think that's interesting, especially as we look at potentially some headwinds to consumer discretionary spending coming down the pipeline later this year. I think we could see some of that concern manifest. And then also when you look at office, no surprise here, this is relatively unchanged, but as interest rate concerns have faded a little bit on the office side, weak tenant demand is still by far the number one concern on office. The good news is I think less new construction in office, as we saw on that prior slide, it may help here, but was still pretty some big structural issues there on the office side of things. We also ask about changes in asset values by asset class. So multifamily and office investors both believe that asset values have declined year over year. We have seen some growth in the retail and industrial space right now. One reason I like to point this out is because our data right now is showing some numbers that are below some other industry standards right now, or some other industry indices that rely on things like transaction data. This is where I think the survey is super valuable because limited transaction volume makes price discovery difficult, right? And I think the sentiment data here is probably more aligned with where values are really at today. I'll also just plug very quickly, we added some more multifamily coverage to our report this quarter. So we dug deeper into some more granular data, some of the index value questions that we ask for multifamily investors specifically. So please check that out. I'm going to pass it over now to Chris as well to do a little bit more of a deep dive onto the multifamily space.
Awesome. Thanks, Alex. Thanks, everybody, for joining. As Alex mentioned, I lead our rental research here at John Burns, and so I'll focus a little bit more on what we're seeing in the multifamily market. Coming into the year, this title would have been, the title of this slide would have read, "Looking Forward to 2026, a Year of Transition," full stop. I think we now certainly need to add the uncertainty factor. There's a lot of uncertainty, whether it's in the macroeconomy that Alex mentioned, but a lot of issues around our industry as well. So we do have some tailwinds. Supply growth will fall significantly. So Alex just mentioned that supply is the concern today. It is. We've got a lot of supply currently being worked through, but we can see into the future and supply is coming down. So I actually view that as a tailwind. Even though our current survey says it's a bit of a headwind, I think the future of supply will be a tailwind. Affordability on the rental side is very strong compared to the for sale market. But looking at the headwinds, labor market, it's weak. It's not as strong as it was 12 months, 24 months ago. And that's really starting to show up in the data. Weak consumer sentiment as well. And then the new one that I think we have to talk about, and I'll talk about in just a second here, for those who are in the BTR space, the legislative headwind that is the 21st Century Road to Housing Act. So let's talk about what we know regarding that bill. So it's likely to pass the Senate today. It'll go to the House for approval. Now, we have heard that there is some disconnect or discontent, I should say, in the House over the new language that would require BTR properties with 1 or 2 units to be sold within 7 years. So in all likelihood, the House will go back to the Senate. They'll form what they call the conference committee, where they basically negotiate and reconcile the language between the two bills. So there's a glimmer of hope that we could see that BTR disposal requirement language removed when they go to committee. But as of now, the bill as it's currently written, which again would require BTR, purpose-built BTR communities with 1 or 2 units to be sold to individual buyers within 7 years. Attached properties, anything with 3 or more units, so think townhomes, horizontal apartments with 3 or more units, those are exempt. And so if that's kind of where your focus is, or if that's where the industry is headed, those would be exempt from this bill. But it's the single family detached, it's the duplex homes that would be heavily impacted here. And what we know is that existing owners of BTR communities will not be subject to disposal requirements. So if you're under construction, if you own your deals, if you're in lease up, those properties, as we and as many in the industry are interpreting the bill, those will be grandfathered in and can be traded from institution to institution into perpetuity. Where this bill really will impact us is on the supply side. And we think it will significantly lower the amount of new supply, specifically in BTR, an asset class that's been growing in popularity, been growing in its share of the overall multifamily market. This will hurt supply significantly. So enough about the politics in Washington. I did feel compelled to mention that just because it's so top of mind with anyone in the BTR community. But let's kind of dig into what we're seeing on the demand side. As Alex mentioned, as I mentioned, the job market is slowing. You can see the chart on the left here. That blue line, that's overall job growth. We're pretty much flat, growing at about 40 basis points. High earning job growth, those are the demographics that we often see in some of the new multifamily stock, the Class A multifamily stock, BTR as well. That number has been negative for the better part of 2 or 3 years now. And so that's really been a demand pull that is just starting to have an impact on the market as we've seen supply come down. The perhaps silver lining on the demand side is that we do expect, and this chart on the right comes from our demographics team, we do expect the rental market to get a lion's share of the household formation that takes place for the remainder of this decade. Alex mentioned high interest rates. We expect mortgage rates to remain high. We expect for sale home prices to remain high. And so it's still meaningfully more affordable for people to rent than it is to own. This is some similar data looking at the renter household growth compared to the owner household growth. You see, really, since rates started going up 22, 23, since the middle of 23, the renter household growth has accelerated. The homeowner household growth has decelerated very quickly. Again, we expect this trend to continue given where interest rates are, given where home prices are. So while we do see overall demand slowing, the demand that is created, the households that are formed, are likely to be renter households. This is looking at supply. So again, as Alex mentioned, we saw in our survey, supply is the main concern. Now, completions peaked back in 2024. But if you see the chart on the right here, this is total number of vacant apartment units. And that is really just plateauing. So for operators, for owners, many of you know this, we still need to work through a lot of supply and lease up, a lot of non-stabilized apartment supply. And we're offering a lot of concessions. Rents are being cut in markets like Austin and Phoenix and Denver and Tampa and across the Sun Belt mostly. But even new lease concessions on lease-up properties in the Northeast are fairly common and in parts of the Midwest. Alex mentioned kind of the strength of certain markets like the Midwest and Northeast, weakness in the Sun Belt. We continue to see that. The lion's share of the vacant apartment units are in the Sun Belt. But I think this is really taking shape, not just the fact that we're past completions. That's good news, right? And you can see the blue bars here on the left, supply is coming down. But we really need to see this blue line on the right start to come down as well before we start to see pricing power return to the multifamily market. So again, these are a couple different metrics. We're looking at units under construction, deliveries, starts, and absorption. There's a lot of good news here, right? The slope of all of these lines are coming down. Deliveries, the slope is coming down the quickest, but it remains the most elevated. Absorption, this has been very strong. I'd say the one perhaps not so good news is that absorption is starting to come down as well. This speaks a lot to demand, to the softness in demand, the softness in the job market, the softness in the immigration market. The domestic migration has slowed down as well. So these metrics right here, the slowing of the construction pipeline, a little bit of the slowing demand, this gives me hope, gives me encouragement that 2027 will be a decent year. But again, 2026 is going to be a transition year, a steadying year, a little bit of an uncertain year as well. And I think a bit of a rocky road to get to a better place in 2027 for most of the rental market, for the multifamily market for certain. Looking at kind of market by market, these are, we break out each apartment market that we track and we rank it very weak, normal, strong, or very strong. 1% of the markets that we're tracking right now, Minneapolis is the only market that we consider very strong. Very low supply in Minneapolis, decent rent growth, decent continued demand in the Twin Cities. But that's the only market that we consider very strong. Just a handful of strong markets, the Bay Area, San Francisco, South Bay, San Jose, certainly with all the AI boom that Alex talked about, the tech boom. Pair that with very low supply in the Bay Area and California in general, and you've got rents growing once again. Handful of markets in the Midwest are strong, but most of the markets are weak or very weak. You look at Texas, you look at the Mountain West, Denver, Salt Lake, Phoenix, into Florida, South Florida, really, really weak. Fort Myers continues to be one of, if not the weakest market in the country. The rest of the Sun Belt may be a little bit better, but still pretty weak markets. Negative rent growth, working through that supply. The Carolinas are an area, though, that I'd focus on. We still rank them as weak and very weak, but I would expect the recovery to take shape a little bit quicker in the Carolinas than perhaps in some of the other markets in the Sun Belt, like Florida, like Texas, out west in Arizona as well. So I think if we were to fast forward a year from now, you'd likely see a little bit more green. You'd probably see a lot more yellow and maybe not as much red. But again, I don't think we're going to see this hockey stick, this checkmark recovery, because we're seeing weaker and weaker demand fundamentals appear in the form of job growth, in the form of immigration, in the form of weaker migration growth, and a slowing overall household formation. So with that, I'll kind of wrap up. I do want to do a quick plug for the surveys that we do outside of the Fear and Greed survey. Alex mentioned we've got 16 or 18 different surveys. So on a regular basis, on a quarterly basis, I should say, to be more precise, we survey apartment developers and investors. We also, on a quarterly basis, survey all of our build-to-rent developers, operators, and investors. So if you are an apartment developer, a BTR developer, owner, operator, investor in those spaces, and you'd like to participate in our survey, we will send you a free copy of the survey as well for anyone who participates. Please reach out to me. Please reach out to Alex. Please reach out to anyone on the JBREC team, and we'd love to have your involvement in these quarterly surveys. As Alex mentioned, a lot of our data comes from raw data sources, whether it's publicly available or third party, but a lot of the data that we get and a lot of the sentiment that we get comes from these surveys. It's a little bit more forward looking. So anyone who's interested, feel free to reach out to me, reach out to Alex, reach out to our team. We'd love to have you involved. With that, I will turn it back over to you, Alex, to wrap us up and bring us home.
Great. Thanks, Chris. So yeah, wrapping up in the last 2 minutes here with a couple of key takeaways from our survey and some of what Chris was mentioning as well. I think the key takeaway for me is, investors are still on pause. 72% of investors are holding their investments steady. We do see that access to capital is still a big constraint. Less so than it was last year, but still access to capital is limited, and especially with some of the developments recently, we're not expecting a lot of rate relief to come this year. And so I think that's a potential challenge for the space as well. Then just in addition to access to capital, I think investors in the commentary that we got are wary of political and economic uncertainty right now, as well as some of the sector-specific headwinds that I'm going to mention in a moment here. When you look at the sectors, some takeaways for multifamily, I think, as Chris went into, I think oversupply is the concern for 2026 specifically. And that weakness, I think, is being compounded by the softening demand that we're seeing in terms of absorption, in terms of the labor market. But still, I think there's the evidence that we have is, as Chris mentioned, that this is going to be a headwind for this year, maybe a tailwind when we look at the outer years of our forecast for the multifamily space, as construction pulls back and rent growth maybe firms up a little bit in the outer years. On the industrial side, industrial is clearly the strongest sector right now. I think this is probably aided by in addition to general economic conditions, I think it's aided by data center adjacency. The census considers data centers to be office, but I know a lot of the industry considers it to be industrial as well, and so I think that's probably driving some of the strength. Retail, steady, but I would say that retail is probably the most exposed to consumer cost of living pressures, especially when we look at things like oil prices going up. If this becomes like a longer term issue for the consumer, you could see discretionary spending pull back, and you could see some potential weakness there. Something to watch for. Then office, I do think we've seen some major improvement, especially relative to when we started the survey about 2 years ago. But demand is still soft for office. So as always, watch for distress in these markets. Potential tailwind there, just like on the multifamily side. I do think that falling new construction will help the market find balance. I just think for office, it's going to take a bit of time here. Some opportunities. We always like to end on opportunities. Again, medium-term opportunities here for rentals, especially. I think once the supply glut clears, obviously there's opportunities beyond the core sectors here. Consider alternative opportunities in sectors that fit your risk and return profile, and then look for distressed opportunities as well. We always, fear and greed survey. We got a great quote of "Be greedy when others are fearful." There's opportunities out there for certain risk tolerances. So with that in mind, thank you all for listening. Just a couple questions. If you want to access the full survey results here, feel free to download the whole data report. It is free. It's available on CRE Daily's website. It's available on our website as well. If you want to get future surveys sent to your inbox, sign up for the John Burns and CRE Daily newsletters. CRE Daily does a daily newsletter to your inbox, everything going on in the commercial real estate space. We also do residential and commercial real estate analysis, typically 1 to 3 times a week on our blog, so definitely subscribe to that. And if you want to participate, first of all, if you already participated in the survey, thank you very much. We really appreciate your continued support of the survey. If you'd like to participate, sign up for CRE Daily's newsletter, and you'll be invited to participate in the survey every quarter. So with that, thank you very much. Feel free to reach out to us with questions. We're always happy to chat. Thank you all.